Hello, let me introduce myself. My name is Amelia, Putri, Class Management 23C. NPM 234111027. Financial report analysis is an important thing to do. This is because a financial analysis will describe the health of the company. This method can also increase company development. If the company develops well, it means the company's goals are getting closer. In general, finance is one of the most important components in describing a company's success. Success can be measured by how healthy the financial condition is, as well as the rate at which profits are achieved and stability therein. So, financial reports are really needed to manage the health of the company. The financial report itself is part of the financial reporting process. This activity is usually carried out by audit parties in government agencies, firms, accountants, and other institutions. The aim is to ensure accuracy and objectives related to financing, taxes, or investments. Basically, financial reports are divided into balance sheets, profit and loss reports, cash flows, and changes in capital. These types are useful sources of information. This report will also be used by companies or stakeholders, for example investors. Purpose of conducting financial report analysis. The main aim of analyzing financial reports is to find the basis for strategic decision-making as well as basic information regarding business value. However, there are several more important purposes why this analysis is important, including understand the company's potential to pay off debt and interest, both long-term and short-term. Understand the company's potential in utilizing assets to generate profits. Knowing changes in financial position in a period. Projecting what the business will be like in the next period. Assess business performance in the current period. Comparing the company's own value with the value of competitors. Identify financial areas that are experiencing problems. Becomes a consideration for investors. For example, if they want to invest in a particular company. Becomes a reference material for the government in determining the amount of tax that must be paid by the company. Determine the developments experienced by the company. Knowing how much damage has occurred. Types of financial reports that can be analyzed at the beginning of the discussion. It was stated that there are a number of types of reports that can be analyzed. In analyzing, accountants or company owners must use different methods on different financial reports. Before that, what types of financial reports can be analyzed? 1. Balance sheet in the field of accounting. A balance sheet is a company's financial report, which contains information on assets, payment obligations to related parties regarding operations, and capital in a certain period. The components in the balance sheet are asset history data. 2. Profit and loss statement. This report will show the company's financial situation, whether it is in a state of loss or profit. Usually, there are many records of company losses and profits in this report. These records are obtained from the results of product sales and expenses incurred by the company. 3. Report on changes in financial position, cash flow. This report will show the accountant or manager how the company's cash has been used so far. This means that managers can monitor all sources and how company funds are used. 4. Capital change report. The capital changes report will show the decrease or increase in net capital in a period. Making this report requires an income statement. This is because accountants must pay attention to the nominal capital at the end of the period after deducting the company's losses/profits. Financial report analysis methods in analyzing financial reports. Of course, there are several methods that can be used. Broadly speaking, there are two methods of analysis. The first method is the horizontal method, while the next method is the vertical method. 1. Horizontal analysis. The horizontal analysis method is a method of comparing each of the same items in financial reports from different periods. Usually, the comparisons to be analyzed are based on 2 or 3 earlier periods. 2. Vertical analysis. The next method for analyzing financial statements is vertical analysis. This analysis is often used when comparing different financial items in the same report and in the same period. This method is often said to be a static method. 3. Industry analysis. Apart from the horizontal method and vertical method, there is another method in financial statement analysis. The name of this method is industry analysis. This analysis will compare the company with companies in similar fields.